Alright, hello and welcome everyone to the third week of Engineering and Investment. I am your host Austin, and hope you all are having a good week out there, getting ready for the 4th of July. I'm having a pretty good week. I'm glad it's Friday. Today I think we're going to do some follow-ups on some of the stocks we talked about in the first installment. As you see, I have NRG pulled up here, and just going to follow up on them and potentially a few others, and there's some more recommendations to look at, and maybe we'll peruse the screener to see if there's anything else we want to look at. So let's get started. NRG, for those who missed the first broadcast, or for a little reminder, because it has been a few weeks, they are a utility company out of Texas, and we talked about them a couple weeks ago. They had some poor share price performance, and my brother really wanted me to look at them, and as we can see, recently, this past week, they've bounced up and have gone over the orange line, and see they've had pretty good little rebound. So if we're looking at price right now and forecasting, if we're still looking at the price, it's still a pretty good return projected, because they are projected a lot of growth over the next 3 years to justify an even higher than 15 PE. Even if you if these growth projections were right, but you didn't get to the expanded multiple, you could still be looking at low double-digit returns, like 12.5. Again, these numbers are estimates. These aren't. I'm not promising 12.44% return in 3 years. It's just a kind of a ballpark number of what kind of thing you could get. And when you're talking about investing in a utility company and getting a stable, predictable return like that, that's a pretty good. Like, if we look at what the analysts, how they normally perform, the analysts are pretty good, but that makes sense because it's a utility company, very highly regulated, very predictable income, and a regulated to be profitable industry. Their dividend yield, it's still a pretty small dividend. They've had 6 years of consecutive dividend increases, with 14 consecutive years of paying their dividend. Just wanted to follow up with that one because it has had a pretty good performance the past couple of weeks, or since the last time we looked at it. The other company was this drone maker, and they have had a pretty poor performance in the past week, and I added them to the tracker, and I remember I was saying wanted to keep an eye on them in case they ever did come into fair value range, that it might be a good. Wanted to watch them because it might be a good company, that it's a good time to see if a time to buy. So they're just now coming down to their average PE, which is still at a market premium, but they are forecasted a lot of growth in the future. So if it projects, if it keeps up the PE that it normally has, its average, which is 45, which is a high PE, its growth rate's enough to justify it. You'd be getting 27% growth, which is pretty high. If you get multiple contraction, then your return goes down. So you could be buying this company, which could be a very good company and grow its earnings a lot, but if you're paying too much for it, then it won't be. Then it's not a good investment. So they make drones. They've been beating on earnings lately, but it's not very predictable 2 years out, I would say. If you think that there is going to be more conflict in the future, I mean, the Memorandum of Understanding in the Middle East theoretically should stop some fighting, but let's be real, their death, taxes, and war in the Middle East are the things you can count on in life. And then I think there's always the threat of China having a conflict over Taiwan. So the defense space, I think, normally trades at a premium. You still have Russia, Ukraine, where drones have really proven themselves to be the premier battlefield tactics, and so this company is pretty well set up to have the macro tailwinds. I think I'd still be looking for this to drop just a little bit more, have a really bad day, and see if I can't scoop this up at a lower valuation. Now, that's not investment advice, and I would still have no position, but I've been watching this one, and it's coming down into potential range. So that's the follow-ups I wanted to do today with on some of the stocks we already looked at. There was something I forgot to mention with Coinbase that I didn't actually know from last week, which was that they are actually getting into prediction markets. So, Kalshi, Polymarket. I think what that proves is that crypto has lost all of its hype, and everybody that was a crypto bro like 3 years ago is now in prediction markets and AI. And the proof is Coinbase is now in prediction markets. So we looked at them last week. I don't know what prediction markets is going to do for their income, but if you want a public way to trade prediction markets, Coinbase might be your option. Now, anytime a company starts moving outside of its sphere of what it was meant for, that should send a big red flag, because Coinbase, the Bitcoin wallet trading platform, is now moving into prediction markets. That's a big shift. So I'm not quite sure how that's going to go for them. So good luck to anyone investing in Coinbase. A couple stocks that have had pretty big drop-offs. I think they've had big drop-offs. I don't know. I was going to check out excuse me, see how Netflix looks. So Netflix had pretty poor performance lately. It's fallen. Looks like it's fallen below the orange line, and it's probably blue line, way above its orange line. But this historical line can be misleading because it takes into account the growth rate from the past. So we should look at the forecasting, but from the initial, this is a quintessential chart that I'd like to point out for the fast graphs. Is we got amazing earnings growth, exponential, and we see that the share price really took off, and then we see that it craters back and does mean reversion back under this orange line. And then, so just to prove the point that share price is always going to follow earnings. So we can look at the forecasting now and see what this looks like. So it still looks expensive going forward here with some strong growth, but you're still paying a decent premium for this growth. If we take a look at how the analysts are at projecting this stock, we see that Netflix typically beats on current margins and future. 2 years out is hard to predict for anybody. But if we look at If it goes to if it goes to a price to earnings ratio of about 18, which would match its growth rate over these 3 years, we could be looking at a dismal 5.5% per year. But if it trades at the premium that it normally trades at, which say around 20 price to earnings, we're still only looking at a better but not that great 9.3% return. Again, these are kind of ballparks. No one's really going to be guaranteeing 9.33%, but so Netflix, there's a saying in Silicon Valley, I heard this was eat your own dog food, meaning if the consumer doesn't use a product that you think you're going to own the company, and if you don't like the product, then other people probably won't like the product. And there's been so much competition, and I don't know that Netflix really has the best content. I don't really watch anything on Netflix. I mean, there is the brilliant TV show Trash Truck on Netflix that happens to be one of my son's favorite shows, but that's probably the only thing I've watched on Netflix in the past 6 months. So just based on the quality of the product and the valuation currently, I don't think Netflix is standing out to me right now. It would have to drop a lot further for me to be interested in it. Let's go with the next stock I want to talk about is Uber. This one is another one that's been kind of interesting to watch. It's one of those IPO darlings. We see it doesn't have the biggest history on it, and it wasn't profitable for the longest time, but it's coming to profitability, and it's projected to not be growing as much, but in the short term, but then ramp up its growth again. So if we go to the forecasting page and we check out, so basically next year it's going to lose 30%, but then the next year is going to gain 30% off of that. Is what we got. 39 and 40 analysts covering this stock. That is an insane amount of analysts on this one. So that's a lot of analysts. Wow. If we look at it and go to it's not going to grow enough to be worth more than 15 PE. You're really looking at low single-digit returns on your investment if you bought it at these current prices. I don't think that's enough to really justify owning it. Again, with the product, I mean, Uber is great if you need a ride from the airport or something, and it's probably decent in big cities, but most of America isn't big cities. So I don't really see. I think I'm not a fan of Uber. I don't think it's at this point worth it. Let's see how the analysts do at predicting it. So Uber does really well at beating what the analysts are expecting. So that would be what you really need to hope for when you're looking at the current valuation. Is please let Uber do way better than what the analysts are expecting. Now there's 40 people predicting what Uber is going to do. So are all 40 of them going to be well under what's going on? Possibly. I mean, how much do analysts really know? They can't predict the future. But what would be the avenues for Uber to drastically outperform these estimates is you'd need more people taking rides more places, and it would be out of my sphere of knowledge because I don't know I don't go anywhere or have a use case for Uber or be in an area in which I would hear about Uber doing way better than Uber having a huge growth. Maybe one day when Tesla's robo-taxis and you can have your robo-taxi be an Uber driver without a driver. Maybe that's what's coming. I'm being facetious. I don't think that's gonna happen. Alright, let's check out another meme darling, Palantir. So let's look at the historical graph first, just to check it out. So this is the kind of earnings you like to see, a nice rising chart. But as we see, the share price got way out of proportion to what the earnings were doing. So if we go back here, we still have this. I think it's just because the graph is so zoomed out that the line looks close to the orange line, but I don't think that's well, I guess here it would have been the line. I mean, you would have been paying 100 PE, well, it would have been worth 20, so it's not like it ever would have been close to fair value. It just looks like it because the graph is so ridiculous. The graph is so ridiculous right now. Let's check out forecasting. So if it keeps trading at 100 times earnings and its growth stays at its growth rate, you could be looking at 50% year-over-year return. But if it goes down to a multiple of 50, which is I guess reasonable for the huge growth it's projected, you'd be getting, even if you bought it at the current valuation and you got the multiple cut in half, you would still return 12.61% year over year. I think this stock, you could easily attach a premium multiple to it above its growth rate because it's going to be so sticky with government contracts, and it's essentially the mass surveillance future that everybody's worried about. So I could see a premium. So say, 100 PE is ridiculous, but a 60 multiple, you're talking about 25% year-over-year return. I actually don't hate this much as I thought I was going to hate it, but this is contingent on 82% growth, 92% growth, 42% growth. That's projecting a lot of growth, and they've always beat estimates. So this is one of those. And also, to own this company, you have to be totally okay with basically owning the corrupt surveillance state AI that is going to basically put the United States in Big Brother mode, where we're going to have our social credit scores and all of that. So there's always that to contend with. But hey, if you're a shareholder, maybe you'll get special privileges in this dystopian future. So you tell the robot on the street, "Stop! I'm a shareholder." Maybe that maybe that saves you. So maybe it's worth buying it at any valuation just for the sole purpose of that. I just came up with a new investing thesis for this company, and maybe that is I think that could be a potential. I think what I would like to see, maybe we can wait for a nice downdraft and get this at an even cheaper valuation. But this growth rate, I think it's coming purely from government contracts. So rain or shine, the government's going to print money and spend it. So it's not like how the macroeconomics are doing are really going to affect Palantir. So I think that's been my favorite that we've looked at so far today. I guess we can follow up ServiceNow. It's been a week. I looked at this last week too, but it's a favorite. It's a show favorite at this point. So I would project this to get around 10 to 11% based on this chart essentially at the $98 mark. I think just to give it a little follow up from last week, if we look at this chart, wow, that's way below, but that's just with the growth rates of the past baked in to what the fair value would be of 47. This is another stock that I actually have a position in this stock from a long time ago. So I was just going to check it out to see. It's kind of been bouncing around. I think it's just fun to see that, oh look, the share price follows earnings. That's just, eventually share price follows earnings, and that's the great truth of investing. So no matter how much hype or things get carried away or things get beaten up from bad news, as long as they keep earning money, then eventually the share price will follow. So Owens Corning excuse me, sorry about that. I think this is a good point for me to say, if you're enjoying this stream, make sure you like and subscribe so that way you can see my company analysis every week. And if you have companies you want me to check out using my analysis and give my my pontificating opinion on companies that I may know nothing about or may know a lot about, then put them down in the comments or put them in the chat, and I am happy to take a look and give you my opinion. So now that break is over, let's go back to talking about Owens Corning. So they are a company that manufactures roofs and insulation. So essentially how and they make, I think they do something with fiber optic too, like make something. Anyway, they make things. That is their business. And so particularly in housing, so roof repairs, new construction, things of that nature. So what we see here is that we're projecting some earnings fall off, and then the earnings to pick up in another 2 years. This is a cyclical industry, and we're on the down cycle right now. And typically in cyclical industries, you want to be accumulating in the down cycle and selling in the unloading period. So it's been a little bit worse than the analysts have projected 6 months ago. The earnings are less than what they were, but let's see, 6 months. Yeah, everything's come lower. So at this point, we could be, if you bought here, you could be looking at a 20% year-over-year investment or return on your investment. They do pay a little bit of a dividend, and they keep increasing. They've increased their dividend almost every year that they've had a dividend. So at this point, I might be looking to add to my position. Just based on this graph, I want to have a better understanding of is this really going to be the bottom of their earnings, and are we going to start seeing a rebound after that? I think I would need to do some more digging on that and figure out, just maybe get some more insight on where these analysts are getting these numbers. So I think Owens Corning is a very strong business, and I'm interested in. I mean, obviously, I already own them, so. But see, we have cycle, and then it comes back up, a little down cycle, then it really took off, and now we got another down cycle. So it might be time to start loading up in the down cycle again. Another company I remember looking at a long time ago, but I haven't really. Okay, this was the company that makes like four-wheelers and the side-by-sides and things of that nature. So they used to have a really strong fast graph, and then all of a sudden they just tanked. So I was looking at it around this period. This is just kind of a risk. This is to show that this software isn't always perfect. I was looking at it in this time period, and the orange line had it going up and to the right, but as we can see, the earnings have just fallen off a cliff. So I'm not sure what happened to this company, and to the point where they made no money. They went from $10.5 a share to 0. So I'm not sure what happened. I just wanted to point this one out as a potential warning for everyone of, hey, just because the analyst projects something, and it's all well and good to look at the orange line, black line under orange line buy, that's not exactly a foolproof plan. You could have, oh, the black line is under the orange line here, and the orange line's up and to the right. It'll be fine, but this one did not work out. I wonder. I guess ATVs got way less popular as Americans stopped going outside. So, see, 83 PE is what it should get, because it's projecting 1,000,000% growth, because it's going to go from 0 to $1. So, obviously, you're going to gain so much money. But this is one of those where this tool is a little bit flawed, and you got to use your brain a little bit more than that. I wonder what happened. Let's look up Molson Coors. This is another one that's it's gotten crushed. But beer drinking is going down. It's a trend. Young people are drinking less. If they are drinking, they're drinking craft things, not, as my friends would call it, tractor beer. So I can see why this isn't given that big of a multiple. It's still, well, we got earnings declining in the short term, but a stabilization and a potential little bounce back in the future. But not something I'd be looking. I'm just looking at this point, I'm just kind of looking at companies that I remember I used to follow a little bit, because the black line was well under the orange line, and I thought, oh, I should watch this and do a little bit more research. I'm glad that I made those decisions, because they've gotten crushed. I'm just going to follow up on the Darling Charter, because this is another one of those. What's gonna break? Is this orange line gonna be wrong, and this is gonna crater and come to the black line, or is the black line gonna come to the orange line? And that is basically the question. My thesis is that internet is not going away, and they have so much free cash flow they're gonna buy back all their shares. So that's why that's not gonna go anywhere. Let's see. While I'm thinking of things to search, leave your best ideas in the comments below. I think that Amazon has been doing alright. So their black line is coming into contact with their orange line. Amazon is not known for turning a profit usually, because they always like to reinvest for more growth. They always follow, I think they track their operating free cash flow better. Just because they like to do their, so it's almost, you can see the black line is on the orange line of operating free cash flow. Amazon almost looks like a screaming buy based on this chart. I think the thing that we need to watch out for with Amazon at this current juncture is just how much capex they've spent on these data center buildouts. So as we saw in the historical chart, the Amazon share price follows their operating free cash flow far more than their earnings. just because Amazon for the longest time reinvested and was never actually making earnings. So they're actually projected to grow their free cash flow a lot over the next few years. So if you got the proper return on multiple from this point, Amazon's actually looking really cheap. The thing I'd be cautious with is how much capex did they spend on data centers and what's the ROI going to be on that? Because we could start seeing a very large hit to that when they start depreciating their GPUs. We haven't really seen a benefit in the AWS revenue from their earnings calls, so it's just something to watch out for. I think a lot of these big tech companies, their future outlook is very inflated based on the optimism from the data center build out. But I think there's yet to really show anything for that, and they're just kind of, they spend all this money and they expect this, but I don't know. So at this point, Amazon looks like a screaming buy on this, based on this, but I don't know if it's to me it's a more wait and see, and this is always my bias is big tech. For me to get 20% year over year on Amazon, who's already a $1 trillion company, they have to grow by hundreds of billions of dollars per year. And that just seems more difficult than a small company growing by, a $10 billion company growing $2 billion. This seems easier than a $1 trillion company growing by $200 billion. But that's, my bias has always been against big tech, and I've missed out on some just because I just don't like those companies. And now if we look at Tesla, devoid of any reality for anything, it's just a pure Elon cult based on nothing but hopes and dreams. So Tesla, it's if you think that self-driving cars are coming and this is where, and everybody's going to have battery packs on their house and the Optimus robot's going to be doing your dishes, then this is the valuation of Tesla. That's for you. It's cheap to you. But if you value Tesla as a car company that sells cars that people buy, then you shouldn't be touching Tesla ever, because it's so huge. It's the most valuable car company, more valuable than every other car company combined, and it sells far less than any other car company. So I just wanted to put Tesla on this because it's ridiculous. Even if we do, let's see, operating free cash flow. Okay, it looks better, but it's not. You have bought it in like 2022 with some, or 2023 with some level of justification, which you would have done well, but it's not like you got right, because I guess Elon just has that effect. But I don't know. I just think Tesla looks hilarious on this graph. There's another one. What else should I check out? I'll check out. Let's dive into the metaverse. Alright, big tech with it's starting to look like it's coming into buy range. So low single digits if you buy it at its current valuation. It doesn't trade at a premium, but Facebook's always going to trade at a premium because Facebook has everybody's user data. So in the world where data is an asset, then Facebook is asset rich. Let's see. I didn't realize that. I think they have a little dividend, so they can get into the dividend dividend funds and get auto bids going, you know. With that being said, my catchphrase, with that being said, let's check out the screener and see if we can't find any cool companies to invest in. Anybody ever hear of Jack Henry and Associates? I have not, but they popped up on the screener, so let's check them out. It says IT, so that could be anything from let's check out what they. Well, this is a solid earnings growth chart. The price got a little bit over its skis, and as we see, we're reverting to the mean. I just want to continue to point out that share price follows earnings in the long run. So, to everybody investing in companies with no earnings, I hope that they find earnings for you eventually. If they come down to what normal multiple, or like what a multiple for their growth rate would be of 15, then you're actually losing money. But they have a decent low growth rate going, and they pay a little dividend. They must have been around forever. It says they're in payment processing. I don't know if I've never heard of this company, so I have no idea what they do. But it looks like it's very stable and predictable. So they probably ought to be coming down in valuation a little bit. If they did come into the fair value range, you'd be looking at like a 9% year over year. How I'm getting that 9% is I'm just projecting if they come down. I'm taking the same PE they're at and projecting it out to what that same PE is in the future to get what kind of earnings yield you would get, and you're looking at a 9% return. So based on that, not something I'm looking for, but interesting to look at from the screener. Bentley Systems Software. ACOM popped up last time we took a look. I now know what ACOM is a little bit more. I guess I could pull them up. So they are an engineering and construction. I should look up some of their projects that maybe people would know, but it looks a little bit cyclical because construction is pretty cyclical. But they've recently really cratered, so it might be coming into a buy opportunity because their earnings keep going up, but their share price really tumbled. So this is so 25% year over year if it gets back to a 15 PE, because it has a nice 14, 12, 9% growth rate. Probably has a dividend because I think that's what I said on the screener. If my computer is gonna keep being slow right now. Okay, there we go. Yeah, a nice little dividend. It's pretty new. They've only been doing it for, well, I guess they've only been doing it consecutively for 4 years. I don't know how long it's been, but they've been increasing it. The analysts are pretty good at projecting, and ACOM's pretty good at beating on the present year, but pretty in line. I should look up some nice projects that they've done that maybe some people would be familiar with. They compete in, it's like I bet they're probably getting they probably will get a lot of small modular reactor contracts or stuff like that to actually do the construction. So you'll have companies come up with, I have this great idea for this new plant or reactor or something like that, and then they'll hire ACON to do the design and construction work. So I am going to put them on my watch list because I think that's actually, I'm interested in owning them. I'm not looking for asset management or banks or insurance or these oil and gas partnerships. Match Group, they do internet content and information. That doesn't sound like the industry I want to be in. Special industrial machinery is I'm just gonna say that's my sphere of technical knowledge because I am an engineer. So generally I like to look at that kind of thing. So we got a pretty nice little earning charts. I like to see these up and to the right. You know, that's always what you want to see. Looks like it potentially cyclical. I think that's pretty typical with heavy machinery. You have capital intensive periods and non-capital intensive periods. You really their growth doesn't look that great, and they're at pretty much a little bit above fair value as it stands. So we're really only looking at a 6% growth. Not really. They've fallen off the list. I think we looked at AGCO before. Not financial data and FactSet. Okay, I guess I clicked that. I didn't really mean to, but wow, they had a plus $22 11% day. They must have some good news. You know, they got AI agents going. That's the good news. Oh wow, my computer's being really slow. So at this moment, again, I'm going to say like, subscribe, and not only like and subscribe, but tell 3 friends. I know FactSet is actually where FAST Graphs, the tool that I'm using right here, pulls all their data from. So FAST Graphs is actually a customer of FactSet. If you find that little fun fact. Talking about eating your own dog food, make sure you like the product. So since I really like fast graphs, maybe it only makes sense for me to like FactSet. They have a little 2% dividend, and they've increased it pretty much every year they've had it for 25 years. Let's see, 18% year over year. Even I don't know if this has the it has the even after the plus 11% day, you could still be looking at 18% year over year. They're really good at beating and hitting on what the analysts think. So this is another one. And so in the time of AI, the people with proprietary data sets are going to be the ones that win. That's my hypothesis. And so FactSet has the proprietary data set. So they are going to be, in my opinion, a beneficiary of it. So that's actually an interesting one. Voya is the 401k that my job has, and I really don't like them, so I wouldn't look for them. Let's go to Eastman Chemical, because that's another one that's in my sphere of expertise. I guess my work calls me an expert. It's hard to believe that, but so chemical industry is incredibly cyclical. I would say that I know about how plants work. I don't know how the economies around it work, but that's a really big dividend. And they've increased their dividend yearly. The analysts have no idea 1 year out because it's so cyclical. If it keeps on this 15 PE, if it goes to 15 PE, you could be looking at a lot of growth. But the analysts also don't really know what they're doing, because 1 year out they have a bad track record. The estimates have been going down, so, well, I take that back. This one came down a bit. 3 months, I think that looks down a bit. Was that down? Chat, was that down? No, current's higher than 3 months ago. So, they're dialing it in. I could see Fast Graphs, or I could see Eastman Chemical being a decent buy right now. I would have to look more at what kind of chemicals they're making and what those are used for and what part of the macroeconomics. But Eastman looks pretty good at this point. Tetra Tech Engineering and Construction, they seem like an Acon competitor. Let's check out what Acon's competing against and see if the sell-off was industry-wide. So it looks like it is, because both Acom and Tetrac had this giant run-up in their share prices and a giant collapse back down to this orange line. So they look pretty similar. I think at this point, when you're picking the two, you gotta look at, if you were to pick between the two, Acom looks like the better value with more projected growth. You'd have to see what kind of contracts they're going and if they're actually competing with each other or if they're in different niches of the construction world. So insurance, Fluor, they're another one. So I guess in my search criteria, I just ended up with all the engineering and construction companies. They got a nice smooth projection going with a lot of growth. They're also going to be a big player in the race to build nuclear reactors, but the analysts are awful at projecting. So I guess analysts are awful at projecting, or this company is awful at hitting estimates. It's like when you make a bad sports bet. Was it you who were wrong, or did the players just play bad? So it wasn't me who lost. It was that 18-year-old kid who missed his basketball shot or missed the field goal. It wasn't me. It was that kid's fault. So as we see, this graph is not the prototypical graph you're looking for. It's not up and to the right earnings. It's just all over the place. So this is not something that I want to touch. Let's see. Credit services, no. Building materials. Gap retail. Anybody want retail? Not really. Lear. I know people that work there. They used to recruit at my school's engineering career fair. Wow, that looks like a funky looking graph. The share price just stays the same no matter what earnings do. I don't know, that just looks funny. So at this point I would probably put what the normal multiple, see what the market, I mean, it looks like they're going to be making a lot of money, like growing 15, 17, 10%. It's just, the market doesn't like to give them a decent multiple at all. I don't know where that comes from. I'd have to do more digging to find out why the market just hates them. If you bought it when they were making money at like 20 PE, and 10% year over year, you're doing all right, but market seems to hate them. Scientific and Technical Instruments. I've never heard of them. Sensata? Oh, a PLC company. They're not Allen Bradley. That's why I've never heard of them. Not Siemens, not Allen Bradley. Everybody gets a break for 2020, right? Well, this is okay, if you look at the share price got way crushed down to a 5 PE, but way below the orange line. This is just another case study that it went from, what did it go from? essentially $18 to $50. It's just another case study that the price, the black line follows the orange line. So I thank you, Sensata, for that nice demonstration of the thesis behind the investment strategy. So utilities, maybe we can find a utility that's just beaten down. So when interest rates rise, that becomes a competitor against utilities because it's a place to get yield for income. So no, that doesn't look that. Alright. Churchill Downs we looked at, that's the horse racing track. Sorry, where were we at? We were looking at the gas. Security and protection services. Interesting. Like I said, this is I try to get names from the screener, and then I look at it through the lens of FAST Graphs to give me a filter to know if I should look any deeper. So it should be a quick screen. So it's the kind of earnings curve I like to see, up and to the right. It's just always traded at a premium. It might be one of those, well, if it comes down to fair value, then maybe I'd want to own it. But I'd have to understand more what they do, because right now I'm just screening it based on their FAST graph. Gold. Portland General Electric Co. As you can tell, I just am a big fan of utilities, just based on what I click on and how I led the show. It's getting late here. I'm getting sleepy. You can buy Morningstar stock. I wonder what Morningstar says about Morningstar stock. It's probably always a buy no matter what on their website. Well, let's check out. Oh, computer's lagging again. If you guys, I need a new computer, it seems. So I need you all to tell all your friends so I can afford to get me a new computer. So that way this stream can get me a new computer. If one day, I don't even remember, they were like IT or something. Wow, look at that. The black line followed the orange line. Not what I'm looking for. I guess at this point I want to take some time to talk about. I have some Python scripts that I want to put up in my going forward. It has some fun. It takes the analysts, basically how well the analysts do in probabilities, and does a Monte Carlo simulation from estimating returns based on the inputs from this FAST graph stuff, and returns a distribution plot. And I have a few other Python scripts that help me, that supplement what FAST graphs do. So I think I'll do those in future episodes. I just haven't really had the time to. I used to use them a lot. I haven't had that much time lately. So I got to get those really organized so that way, and have them pulled up so that way I can show you guys what I'm doing with my some extra cool tools. Maybe I'll start a GitHub and put those up there. So if anybody watching wants to copy what I'm doing, that'd be fun. and anybody else wants to put some of their software tools up, that'd be cool. I think there's one other thing I wanted to look at for my brother because he is a tech guy. So, Snowflake. But, well, they don't really have earnings. I was going to look at free cash flow. Well, look at that. If you would have bought this one day, essentially, you would have been on there, on the orange line. But, let's forecast using the operating free cash flow. Because they're another one of those tech companies that make money by selling $5 bills for $1. So, they got big time percentage growth, but it looks like you're paying too much for it at this current juncture. So another one where wait and see. Oh, there was another one. I remember my dad talking about this a long time ago. Was it unlimited? I thought there was a company called C Unlimited or something like that. I'll have to do it for next stream. What about MongoDB? I remember that like a hot minute ago. Another one of those companies that's just, it's the darling right now. Its share price is way above the orange line. Probably a good one to buy if the share price ever came down to the orange line, but we are far from that. I guess some people might push back, well, they're growing a lot, it's justified to have that premium put on it. And my argument would be is you probably will do okay if the company keeps growing like that, as long as the premium is still placed on the stock. There's not a margin of safety afforded to you if they miss earnings or disappoint in any kind of way. It could send the valuation crumbling, or just say there's massive macro headwinds. So I think we've looked at plenty of stocks in which you could get a similar type growth rate where the value you're paying for that growth is not as high, so it has less room to fall. And so that would be my argument for, I'm sure they're a great company and you want to pay for quality companies, but you want to pay for it at a quality price too, and protect your downside risk, because most of investing, it's capital preservation through drawdowns. Is if you look at geometric returns, protecting against drawdowns and being able to compound your money more because you've been able to preserve it is very important. I think at this point I'm going to have to come up with some names. I'll come up with some names so that way we're not just scrolling here for next week and we can talk about it. I might take the opportunity to flesh out some of the really good names that we looked at that had really good fast graph charts and try to come up with what does the business actually do and give a more in-depth look at those companies, just to make sure that the one step past fast graphs look. Like I said, Finviz gives me the name, fast graphs gives me the quick look, and then there's then you gotta really do your own research to, I would say, validate. The point of the research you're doing is to validate this forecast number, essentially. You gotta come up with, are these numbers feasible? Or are the analysts full of it? And that's essentially what you're doing past the fast graph stage, is just making sure that these pass the sniff test. So next week I'll probably revisit some of the stocks that had really good fast graphs, but I was like, I don't even know what they do, and we can do a deeper dive on some of those companies. And I'm happy to check out any stocks that you guys leave in the comments or the chat, and make sure you like, subscribe, and tell your friends and get them to like and subscribe. And if you want to, spin up your own view bots for me and get those going on my channel. And I'm not going to do that, but if you want to do that for me, that'd be awesome. So that way I can get all the views and you're the one doing it, not me. So with that being said, and if you're a company out there that wants to sponsor me, like Pop-Tarts or Fast Graphs themselves, because I'm using Fast Graphs, that'd be pretty cool. Like, just give me the premium membership for free. That's all I need. Or if a company wants to send me a computer so that way my live stream doesn't lag, that'd be pretty awesome too. With all that being said, I am going to close off now. So this was a fun stream.